Are you thinking about retiring soon and wondering whether or not you should pay off your mortgage before you do? As a CFP that works with people approaching retirement, this is a question that I'm often asked. So in this video, we're going to explore the advantages and disadvantages of paying off a mortgage before retirement. And make sure you stay to the end because I will be discussing what things you should consider before making this decision. But first, allow me to introduce myself. My name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. I create new videos weekly, so if you enjoy this content, please hit like or subscribe and you will be notified when the new videos are released. To add a little context to this discussion, I wanted to have a brief discussion about mortgage interest rates. This graph shows the 30-year fixed rate mortgage since 1971. Now, there is some very interesting information presented on this chart, particularly the skyrocketing interest rates of the 1980s. But for our purposes, we probably don't need to go back that far, as none of those mortgages currently exist. But if we look at the activities since, say, 2007, 2008, we can see that these rates were on a fairly long and steady decline. However, that all ended around 2021, when interest rates bottomed out around 2.5%. But then, in 2022, the Fed made a dramatic shift, and now rates are closer to 7%. In fact, I have clients that have interest rates as low as around 2.6% on 30-year loans and as high as 7.25% for the same term. We haven't seen this kind of jump in mortgage rates in quite some time, and the difference in interest rates of existing loans is significant. So please keep this in mind as we're discussing paying off mortgages before retirement, because the answer may be different based upon the interest rates you might have on your current mortgage. Okay, so now that we have a little more context, let's dive right in. What are the advantages of paying off your mortgage before retirement? Number one, increased cash flow. Eliminating your monthly mortgage payment can free up a significant amount of cash each month. This can be especially beneficial for retirees living on a fixed income like Social Security or pension income. Without a mortgage, you can allocate more of your available cash to essentials like healthcare, travel, and leisure. And this increased cash flow can help provide greater financial freedom and peace of mind. Number two, increased sense of financial security. For many, owning their home outright brings a sense of security and stability. Entering retirement mortgage-free can reduce stress, knowing that you won't risk a bank foreclosure if your income takes a hit or if markets decline. Now, while this may not necessarily be an economic factor, it may be an important emotional one. Number three, reduced expenses in retirement. Housing is often one of the largest expenses for retirees. By paying off your mortgage, you reduce your monthly expenses, which can make your retirement savings last longer. And lowering your fixed costs can provide flexibility and make your retirement budget more manageable. Number four, interest savings. Paying off your mortgage early can save you thousands of dollars in interest payments over the life of the loan. These savings could outweigh the potential returns from other investments. But this may differ based upon the mortgage rate you have on your mortgage. If your interest rate is low, this may not be significant. But if your interest rate is higher, the savings could be significant. Number five, simplified financial planning. Without a mortgage payment, your financial situation becomes simpler. Budgeting is easier when there's one less large bill to account for, allowing you to focus on other aspects of your retirement plan. If you are relying upon distributions from retirement accounts to fund your retirement, you will take fewer and smaller taxable distributions from these accounts, which will help simplify your income tax planning picture as well. Paying off your mortgage can just make your retirement easier. Now that we've discussed the advantages of paying off your mortgage before retirement, what are some of the disadvantages? Number one, opportunity cost. Using a large portion of your savings to pay off your mortgage means those funds are no longer available to invest. If the return on investments are higher than your mortgage interest rate, you may miss out on significant growth. Now, this opportunity cost may be different based upon the interest rate of the underlying mortgage. If you have one of the low interest rate mortgages of the 2 or 3%, you could probably find completely secure interest-bearing accounts like high-yield savings and CDs at higher rates. Or if you are more risk tolerant, you could invest in equities that earn more, albeit with a lot more risk. However, if your mortgage interest rate is closer to 7%, Consistently earning more will be harder, and trying to do so may subject you to even more risk. Deciding your asset allocation is part of a larger conversation. But paying off the mortgage rather than investing will come with some opportunity cost that you will need to get comfortable with. And the opportunity cost will be greater the lower your interest rate is. Number two, liquidity concerns. Paying off your mortgage ties up a significant amount of your wealth in a non-liquid asset. In case of an emergency or unexpected expense, accessing the equity in your home can be more difficult than withdrawing funds from a savings or investment account. And it's important to point out here that getting a mortgage or even a HELOC can be significantly more challenging during retirement. When you were working and you had a high income and great credit score, banks would be more than happy to lend to you. But when you're on a fixed income or Social Security, you may be less attractive. So once you pay off the loan that you have, it may not be very easy to get another. And the terms of the loan will likely not be as favorable. Meaning once you've made the decision to pay off the loan, you might not be able to reverse it. So if you're going to spend much of your liquidity by paying down your mortgage, make sure you carefully consider that obtaining another loan in retirement could be challenging. Number three, lost tax benefits. For some retirees, the mortgage interest deduction can reduce taxable income. However, the value of this benefit has diminished for many after the Tax Cuts and Jobs Act of 2017, which increased the standard deduction and reduced the state and local income tax deduction to $10,000. This is often referred to as the SALT limitation. If you are using the standard deduction, this does not apply, and the tax implications are non-existent given the current tax regime. But if you have a high mortgage balance with a high interest rate and you itemize, you may benefit from retaining a mortgage. Just make sure you understand the tax implications before paying it off. Number four, impact on retirement savings. Paying off a mortgage could deplete savings that are earmarked for retirement. This could possibly leave you underfunded for healthcare costs, long-term care, or other unexpected expenses, forcing you to draw from investments sooner than planned. I often work with people closing in on retirement with paid off homes and high pre-tax account balances. And while this is a great strategy, it's important to understand how this positioning will affect your retirement. You might be house rich and cash poor. And if all of your retirement savings is in tax deferred accounts, any distribution from these accounts will be treated as additional taxable income. This could lead to accelerated depletion of retirement assets as you're having to pay tax on those distributions with more taxable distributions. The takeaway? Try to arrive at retirement with more than just tax-deferred retirement accounts. This may mean not paying off your mortgage so aggressively. Having flexibility and optionality to draw assets from different types of accounts in retirement is a wonderful thing to have. Number five, inflation and low interest rates. As we saw in the graph earlier, mortgage debt can be a relatively cheap form of borrowing, especially when compared to hard money loans, credit cards, and other forms of unsecured personal debt. This is especially true if your interest rate is fixed and low. Over time, inflation reduces the real value of your mortgage payments, making the debt less burdensome. Paying off a low-interest mortgage early might not be the best use of funds when inflation-adjusted returns on investments could outpace the cost of the mortgage. Okay, now that we've discussed the advantages and disadvantages, what are some of the factors you should consider when making this decision? Number one, cash flow needs. If your current cash flow is sufficient to cover your mortgage payment without impacting your lifestyle, it may make sense to keep the mortgage. However, if your cash flow is tight, limiting the payment could improve your financial security. Make sure you understand how any significant deployment of capital to pay off your mortgage will affect your ongoing cash flow position. Number two, the size of your emergency fund. Before paying off your mortgage, make sure you have adequate savings for an emergency fund. This could be 6 or even 12 months in cash or cash equivalents. Depleting your liquid savings to pay off a mortgage could leave you cash-strapped and extremely vulnerable to unexpected costs. If you pay off your mortgage, make sure you understand how this will affect your overall cash position. Number three, your tax bracket. Consider how paying off your mortgage might affect your taxable income. While fewer retirees itemize deductions under current tax laws, it's worth evaluating your specific situation. And if you're not receiving the income tax benefit that you thought you were, make sure that it's reflected in your analysis when deciding whether or not to pay off your mortgage. Number 4, rate of return on investments. Compare the interest rate on your mortgage to the potential returns on your investments. If your investments consistently outperform your mortgage rate, keeping the mortgage and investing the funds may be advantageous. Just remember, past is not necessarily prologue, and just because your investments outperformed historically doesn't mean they'll necessarily do so in the future. Number 5, your time horizon. Your age and expected retirement timeline should play a role in your decision. Those close to retirement may prioritize stability and lower fixed expenses, while younger retirees may be more focused on investment growth. Make sure your analysis views this decision not only on the current cash flow, as previously stated, but on the overall financial picture throughout your retirement. As we discussed earlier, it will be more challenging to get a loan of favorable terms in retirement. So make sure you're contemplating the long view when making this decision. Number 6, what type of assets are you using to pay down the mortgage? Do you plan on paying off the mortgage with the last of your cash outside of retirement accounts? If so, you may want to reconsider. Having flexibility in retirement in different accounts can be invaluable, and having a decent amount of cash in retirement can provide the ultimate flexibility, as long as it makes sense given your financial plan. Number 7, what is best for you emotionally? You need to do what is right for you. If having a mortgage is going to keep you up at night, then paying it off may make sense. If feeling house rich but cash poor is more bothersome, then don't. Like most things in retirement planning, the numbers often shake out in such a way there's usually a path that logically and mathematically makes the most sense. But we're human beings. We're not left-brain androids. We need to make sure we follow a course of action that will make the most sense for us emotionally. So don't underestimate how your mental health will be affected when it comes to making this decision. You can't put a price on a good night's sleep. Whether to pay off your mortgage before retirement is a highly personal decision that depends on your financial circumstances, risk tolerance, goals, and emotional well-being. Take the time to weigh the advantages and disadvantages in the context of your overall retirement plan to make the decision that is right for you. I did another video on the questions any successful retirement plan should answer. If you're working on your retirement plan, it's a very helpful video to watch. You can find a link to that video here. If you've made it this far, thanks for watching. If you enjoyed this video, please hit like and subscribe. Thanks again for watching, and I'll see you next time.